On our first question, statement of financial position for Dura Ltd as at 31st December 2024. The question required us to calculate the company liquid based on the statement above. So basically, the question asks us to calculate the liquidity ratio, and there are two main ratio will be focused on: the current ratio and the quick ratio, which is also called the asset ratio. So the formula we use on the first question is the current ratio formula, which is current asset divided with current liabilities. From the statement of financial position, the current assets includes inventory for the total $1,245,509. So the next is account receivable for the total $726,575, and the last one is cash and cash equivalents for the total $77,960. That adds up to a total $2,015,000 in current asset. Then we look at the current liabilities, which is just $575. So when we divide the current assets by the current liabilities, which is the current asset $2,015,000 divided with current liabilities, which is $575,000, which is equal to, the answer is $3.57. That means for every dollar Dura Ltd owes in the short term, they have 3.57 in assets, which is ready to cover it. That's a very healthy ratio, and it also shows strong liquidity. So next, question 2. If the industry average ratio for current ratio is 4.3 times and the quick ratio is 0.97 times, evaluate Dura Ltd overall liquidity performance. So for the question 2, that where we were asked to evaluate Dura Ltd liquidity performance compared to industry average. So what we were doing here is a benchmark comparison. We're looking on how Dura Ltd liquidities ratio stacks up against typical companies in the same industry. So first, the current ratio. We already calculate Dura Ltd's current ratio in the last question. It was in the previous question, which is first question, it was 3.57 times. The industry average is 4.3 times, which is a bit higher. This could be seen as a slight weakness for an area for improvement. So we can mark the performance here as below or over average, or as labeled in your table bed. Next up, the quick ratio. This one looks much better because we calculate Dura Ltd's quick ratio as approximately 1.40 times, while the industry average is only 0.97 times. This means Dura Ltd's is outperforming the industry in terms of quick liquidity. In other words, they have more readily available liquid assets. For example, like cash and receivables to pay off short-term debts, even if the inventory isn't. This is a very good sign, which tell us that Dura Ltd is in better short-term cash position than many of its competitors. So in this case, the comment is correct or good.
Hi and Assalamualaikum. So my name is Nur Alia Umaira. So I will continue with question 2, Roman 1 and 2. So now I will continue to the question 2. Based on the table given, I need to make a historical analysis of Dura Ltd's current performance. So overall in 2024, Dura Ltd made some good progress. They sold their inventory faster, going from 4.36 to 5.01 times, which means products are sitting on the shelf as long. They also collected payments a bit quicker, with days sales outstanding dropping from 35 to 34 days. But on the downside, they didn't use their assets as well as before. Their fixed asset turnover went down from 6.2 to 4 times, and total asset turnover dropped from 5.1 to 3.9 times. That means they're making less money from things like buildings, machines, and overall resources. So while they've gotten better at managing stocks and collecting payments, they still need to improve how they use their assets to make money. Moving on to Roman 2, which is I need to evaluate Dura Ltd's overall performance in 2024 relative to its competitors using all 4 ratios. So for the first ratio, which is inventory turnover, my evaluations towards Dura Ltd, they has an inventory turnover of 5.01 times, which is lower than Ambon Co and Flexwell Corp. This means Dura is selling its product at a slower pace. Slower turnover can lead to a higher holding cost and may also suggest that products are not moving as quickly as they should, which can affect cash flow and overall efficiency. So for the next ratio, which is day sales outstanding, Dura takes an average of 34 days to collect payments from customers, while Ambon Co only takes 26 days and Flexwell Corp only takes 29.3 days. This shows that Dura is slower in collecting receivables. Taking longer to get paid can create cash flow problems, making it harder to cover operating costs or invest in growth opportunities. Next, for the fixed asset turnover ratio, the evaluation towards Dura Ltd's fixed asset turnover is 4 times, which is much lower than Ambon Co and Flexwell Corp. This indicates that Dura is not using its fixed asset like building equipment and machinery as effectively as its competitors to generate sales. So lower efficiency in assets usage may point to underutilized equipment or poor investment decisions. So for the last ratio, which is total asset turnover, with a total assets turnover of 3.9 times, Dura is lagging behind Ambon Co, which has total asset turnover of 6.4 times, and Flexwell Corp has 5.3 times. This means Dura is generating less revenue from its overall assets compared to the other companies. Lower total asset turnover suggests that Dura is not maximizing the value of everything it owns to boost sales, which can hurt overall performance and competitiveness.
Hello, my name is Muhammad Rizakwan bin Muhammad Zafran, and I will present question number 2, 3 and 4 Romans. So for question number 3, despite any improvement from 2023, is Dura Ltd keeping out with Ambon Co and Flexwell Corp? So the answer is Dura Ltd has improved in some area, such as inventory turnover and receivable collection. However, it's still behind Ambon Co and Flexwell Corp in asset utilization. Its inventory turnover is lower than Ambon Co and Flexwell Corp, meaning it takes longer to sell its stock. The company also collect payment slower than its competitor. In terms of asset efficiency, its fixed asset turnover and total asset turnover are much lower, showing that Dura Ltd is not using its asset effectively as its rival. So overall, despite progress from 2023, Dura Ltd is still falling behind its competitors in financial performance.
Okay, for the next question is recommend any 2 strategy area for Dura Ltd to improve its asset management performance. So for the first one is better inventory management. Dura Ltd should improve its inventory system by using demand forecasting and reducing asset stock. This will help increase inventory turnover and reduce storage costs. Next is improve fixed asset utilization. The company should evaluate underutilized or outdated fixed asset and consider upgrading equipment or disposing of idle assets.
Hi, my name is Aina Nabila. Next, I will move on to question number 3, which is the health of Dura Ltd's debt management in 2024. The formula of debt ratio is total debt divided by total asset. But first, we have to find the total debt, which is long-term loan plus accounts payable. For long-term loan, we have 900,000 US dollar plus 575,000. So the total debt is 1,475,000 US. And the debt ratio is 1,475,000 divided by 4 million. So the debt ratio is 0.37 times. Formula of debt to equity ratio is total debt divided by total equity, which is 1,475,000 divided by 2,525,000, which is 0.58 times. Next is the importance of healthy debt management for the long-term continuity and sustainability of a business like Dura Ltd. The debt management is important because it helps the business stay financially stable and avoid problems like not being able to pay its debt. By keeping a debt at a reasonable level, the company won't have to spend too much on interest payments, which means more money can be used to grow the business or handle unexpected expenses. It also can build trust with banks and investors, making it easier to borrow money in the future if needed. Good debt management reduces the risk of going bankrupt, especially during tough times, and helps ensure the company can continue running smoothly for many years. Hence, it also can improve profits in the long run with lower debt-related costs and better control over finances. The business can use more of its income to invest, grow, or reward its shareholders.